Welcome to episode 4 of the Magic Hour. Today we're going to be talking about venture capital, safe notes and beyond. We're also going to talk about startup accelerators, the scene in Silicon Valley and what's been happening. Welcome, Andrew.
Welcome, Paul. Nice to see you. First question I have is, where are you?
Yes, quite topically, I'm in San Francisco this week, so not in the studio today, but yes, over in San Fran, and it's my first time over here, first time to the US, in fact, and yeah, it's been quite the experience so far.
Fantastic. And well, many questions about San Francisco. It's one of my favorite cities in the world. But why are you there? And if you want to talk about it, what's the mood like there? I know there's been a lot happening in Silicon Valley, just near San Francisco this week.
Yes, it's pretty ironic timing coming to. We actually went to Silicon Valley earlier in the week, so yeah, a bit of news about Silicon Valley Bank this week. I'm actually over here as part of the SVG Thrive Accelerator. There is a large cohort of us over here. I think there's about 60 companies, 60 businesses, 60 founders from across the world, not just from Australia, but Canada, Brazil, Israel, right across the globe as part of the accelerator, all in our sort of separate cohorts, I guess, as it were. And, well, I guess on the accelerator is, a 12-week program that Magic Valley is a part of, which kicks off with this week in Silicon Valley, in San Francisco. And the program basically runs for 12 weeks. We'll be here for 1 week, so I'll be back next week. But the rest of the program, runs for 11 more weeks. And we go through, a whole series of different, I guess, mentor sessions throughout those 12 weeks on various topics. Get introduced to a wide range of people through the agri-food industry, and culminates in a demo day back in Melbourne, I think in June, where we will present the business at a demo day in a pitch, basically, in front of some investors, a network of investors, and obviously other people from the industry, and look to gather some more investment from those parties into the business. So look, it's a really great program. Really looking forward to the rest of it. We've had quite a few sessions here this week. Also met with a number of people from Austrade, Global Victoria. So there's plenty of Aussies over here. Actually, we went to the Irish consulate one night as well. John, who I think is the CEO at SVG Thrive, is Irish, and so we were up in the Irish consulate for an event the other night, which has views out over San Francisco, which was really amazing, actually. And we're going through other sessions as well. So the companies in the accelerator are from, so the accelerator is an agri-tech accelerator, and a lot of the companies within the accelerator are involved in various areas of tech, and they're really looking mostly at tech solutions for on-farm efficiencies. So whether that's crops or animal agriculture, or whatever the case may be. So they're all really heavily tech focused companies. But I think we're the only cellular agriculture company. In fact, I'm 99% sure, because I certainly haven't met anyone else in our space through the program. But it's really been amazing to meet so many founders of these really innovative businesses that are looking for all these different solutions. So that's been really great. You asked me about the environment here at the moment, or the mood. I think I was on the plane sort of when the news broke about Silicon Valley Bank. None of this is financial advice, and I'm certainly not an expert in this area. But I obviously do have a finance background, more so on the lending side. There seems to be a bit of a a mismatch in timings, I guess, for inflows and outflows for Silicon Valley Bank, and that'll obviously all play out. I know there's been talk about HSBC and a buyout and government guarantees and all those sorts of things, which sort of happened really quickly over sort of the weekend. And there's just a lot of talk, like it was just a talking point amongst everyone that you came across. What was the impact going to be? Are we personally affected? Do we know anyone that's affected? And all those sorts of things. We're not affected. I actually don't know anyone that has been affected. And so, there was just a whole lot of uncertainty, I guess, and then announcement, of the potential. I don't know if bailout's the right word, but guarantee of funds sort of calmed everyone down fairly quickly. So there was a kind of a bit of a spike and all this uncertainty and what's going to happen, and then that sort of calmed down. But people are still talking about ramifications of that. Is there going to be flow-on effects from companies losing funds or not being able to access funds? How's that going to affect venture capital? There was some talk of some venture capital firms that had money with Silicon Valley Bank and weren't able to access it and weren't able to make payroll, and same with some of their portfolio companies as well. So the timing of being here this week was fairly ironic. But look, who knows how it all play out. It's certainly a talking point for everybody. Whether that'll last for a few weeks and calm down, or whether there'll be other ramifications from that, I guess we'll find out in due course.
Absolutely. Now, there's a couple of questions I had based on what you said. First of all, I'd say happy St. Patrick's Day. It's St. Patrick's Day here in Australia. Not quite there yet for you in San Francisco. I'm interested in how the other participants in the accelerator reacted when you explained to them that we're a cultivated meat company, because if most of them are coming from a traditional agriculture but looking to innovate, what's the reaction like? I mean, not everyone understands it, I'm sure, and maybe some people might not like the idea of it, but I'm interested in your thoughts there, Paul.
Yeah. There's probably a few stories I can't tell, but there's been some some pretty awkward introductions is probably the best way of putting it, because for those exact reasons that you mentioned. But after you sort of I explain what we're doing and why we're doing it. Look, everyone's been really supportive. Really intrigued by the tech. How it works. There's lots of questions around. But how do you do this? But where does this come from? But are you I mean, it's the same questions we get from everyone.
Mm-hmm.
Are you growing whole cuts? Are you growing a whole animal? Are you do you grow the whole muscle? Do you where do you get the fat? All those questions. So it's really just all the same questions. Obviously, as you mentioned, there's quite a number of people with a farming background or an animal agriculture background, and to be honest, I've actually learnt quite a lot, because they asked me, how much, because some of their businesses obviously, are involved in animal agriculture, and they asked me how much I know about the process, and I thought I knew a lot, but I've really been educated this week, to be honest, around what the current process is, which has been very interesting. It's really been a steep learning curve, to be honest, because some of these people have, that's what they've done for a very long time. They know the process. Intrinsically, what they're working on is looking at improving that process, and so they know it back to front. And like I said, I thought I knew a lot. I thought I was pretty well educated on the process, but I've learned so much this week just from those conversations, with them around what they're doing, and looking to do with their technology innovation. So it's actually been really interesting. Very, very informative, and I think on both sides. So for them, in terms of what we're doing, and for me in terms of what they're doing and what existing practices are. But yeah, no, it's a very good question that you ask. But so that's been my experience thus far. Most people are really super interested in what we're doing, and most of them really haven't heard of it before. They didn't know that we could do what we were doing. They didn't know it actually existed, which was interesting, as well, because I mean these are tech people, and I thought there might have been a bit more awareness, but there isn't. Which is interesting, which is I think representative of the the broader community, where we've still got a very large education piece ahead of us. So yeah, no, very good question. Very good question.
So we're interested in what's the, well, obviously apart from our technology, what's the coolest technology you've heard about this week?
Well, I'm always interested in ice cream, and I'll be eating quite a lot of plant-based ice cream this week. But that's probably the coolest in two senses of the word. But no, look, it's been a really busy week. So on Monday night, I actually, after our Thrive sessions, went to the Accelerator sessions, went to San Francisco food hack event on Monday night, and there was. Look, I think there was probably, at a guess, 100, 120, maybe more people there. And there was probably maybe 15, again, at a guess, individual companies there showcasing their food innovations, which, as I mentioned, range from plant-based ice cream to plant-based pork belly to some mycelium products, to a new plant-based honey, to all sorts of different innovations. Too many for me to mention, but all of these companies were doing tastings, which was amazing to try. And it's really not something that I've experienced so far in Australia. These types of tasting events or food innovation tasting events. So the food hack event was amazing, and obviously we are starting the food hack chapter in Melbourne. So it was a really eye-opening event, and how many people were there, and how many people were there from very different backgrounds as well. So there's obviously people that are interested in alternative solutions, whether it's sustainability or animal alternatives, or whatever the case may be. There's lots of people just interested in tech. There are some investors there as well. There's lots of food people, so chefs and people with food backgrounds, particularly people that had their own businesses and wanted to see what the latest innovations were and everything. And it's just an open community event, and it was just amazing that there were so many people there, and it was a great event. But then Tuesday, Wednesday, we had the World Agri-Tech Summit, which is part of the Accelerator program here. So World Agri-Tech Summit on Tuesday and Wednesday. Sorry, I lose track of my days because obviously there's a big difference between here and Melbourne. And obviously we have daylight saving in Melbourne, and they have daylight saving here. And daylight saving ended at some point while I've been here as well, which threw me out another hour as well, which I didn't know was happening. So anyway, yeah, Tuesday, Wednesday was World Agri-Tech Summit. And again, companies all across agriculture. So, whether that's more efficient ways to harvest crops, to fruit picking, to drones that pick apples off the tree, and all sorts of other innovations. There's just too many to mention. And it was full. So there would have been I don't know the exact number, but I imagine somewhere between 1,500 and 2,000 people there, plus obviously all the displays and stall holders and all that sorts of thing. So yeah, it's packed. I don't know San Francisco is always like this, but it's very busy here at the moment. I assume they probably run lots of different conferences at the same time. But I think there's actually a finance conference on here at the moment. But yeah, there's people everywhere here at the moment, so it's super busy. And then Thursday, Friday, which we're halfway through now, is Future Food Tech Summit. So again, yeah, it's a full-on week. So again, lots of solutions and innovations today, particularly in the plant-based space, but also in the cultivated meat space. Cellular agriculture, precision fermentation. There's a number of investors here as well, obviously, checking out all the latest innovations. And so, yeah, lots of different plant-based options for all sorts of different things. Fat seems to be a number of companies working on fat, so replicating animal fat through plant-based means. There's a number of cultivated meat companies here. As well. There's obviously quite a few cultivated meat companies based in the Bay Area here in San Francisco. There's a number of precision fermentation companies here also. So again, looking at dairy primarily, and things like ice cream and your cheeses and your milks. A number of companies as well that are working on scaffolds and bioreactors, microcarriers, those sorts of things that can be used in the cellular agriculture process as well. Yeah, it just goes on and on and on. It feels like sort of everyone is here. Lots of familiar faces from other companies across the world. I've met lots of people in person for the first time that I've had a relationship with for a number of years, which has been really great. It's obviously a lot different catching up with people in person, which has been really good. Lots of other founders here that it's been great to connect with as well. Some of our investors are based here, or at least here for the conference, and obviously looking and speaking to future potential investors as well. So yeah, it's been a big week so far. Still a few days to go, but hopefully no more bank collapses or anything like that.
Fingers crossed. And just to remind you, not everybody is there. There's a few of us back here working hard in the lab and in the office. Cells are going well. Think things are going well back here. Yeah, you just definitely validated my FOMO and increased my jealousy levels a lot with that description of what's been going on and what you've been doing in San Francisco this week. But I thought I'd change tack a little bit. The whole reason we started this podcast with you and I chatting is that we're coming from a science perspective and a business perspective. And the science-based listeners that are listening to our podcast might not really understand what a startup accelerator is. They might think it's something to do with particle acceleration or something. Could you give us a bit of a description of what a startup accelerator is?
Sure. I'm glad to hear everything's going well back in Melbourne. I think the bigger issue is that I missed the start of the footy season, which I'm very disappointed about. We won't go into the result, but yeah, it's very disappointing to miss that. But obviously back for round 2, which I'm happy about. And actually, the weather is exactly the same here in San Fran as is typical in Melbourne. It's very overcast, very windy, very cold, and then all of a sudden the sun comes out and it's actually quite warm, and then it'll start raining, then it gets cold again. It's actually identical. So
just like home.
I do feel somewhat at home. Exactly. Anyway, that's not the question you asked me, which was around accelerators. So yeah, so look, an accelerator, or sometimes called an incubator, is basically for the acceleration of startup companies. So if you've got a startup business or an idea for a business, you might join an accelerator or an incubator, and typically they will provide things like mentorship, introductions, networking opportunities, access to funding either directly or through their investor network, and provide education really to fast track your business, so to accelerate your business. So a lot of people, particularly from technical backgrounds might enter into an accelerator, which is more business focused, to upskill themselves on the business side of things. So you might learn about so you might be a cell biologist or a researcher, for example, and you might come into the accelerator, and you might learn more about marketing and HR and accounting and sales and finance, and all those sorts of things, raising capital, all those sorts of things. And if you had a business that was, if you came from a business background, or you had an understanding of that, and you had, let's just say, a food business, for example, you might learn more in the accelerator about food science or nutrition, or you might want to get connected to suppliers or producers, or find some technical skills, people with particular skill sets, or get introduced to a university or something like that. So the accelerator program really is to do exactly that: accelerate your business. So get you to fast track what you're doing, as opposed to being in a silo by yourself, trying to work out, how do I run my accounting system? How do I do payroll? What's all this super stuff about? How do I teach myself about writing contracts, or all those sorts of things? And obviously put into a shortened, structured program for you to learn and accelerate your business, so you don't waste your time doing that yourselves. And there'll typically be, a cohort of people at a similar stage to you in terms of their business. Sometimes they will have a particular focus, like the SVG Thrive Accelerator is agri-tech focused. So that obviously provides a lot more efficiencies. If you've got a finance, a fintech business, there are various fintech accelerators. There's climate tech accelerators, that software accelerators, and basically across all the different industries. So that's what the accelerator does at a high level. Obviously there's lots of mentorship from people that are much further advanced than you in your field, or in a similar field, or business, or starting a business, or running a business, or exiting a business. So you're able to learn from people that have gone through what you're going through previously, which obviously helps you avoid some of the pitfalls that you can learn from their experience, which I always recommend. I'm a super strong believer in mentorship across all areas of your life, not just business. So that's one of the key benefits. You also, as I mentioned, get to meet other founders or business owners that are going through the same experience as you. Someone you can, or people you can share experiences with, people you can learn from, which is great to share those experiences with other people that are going through the exact same challenges as you. Everyone is experiencing the same economic environment, and everything that's going on from a macroeconomic perspective, and all those sorts of things. Number of companies are fundraising as well, which is something that obviously we're looking at too. So the cohort that you're involved with is another really great benefit of it. Obviously, we've previously been through the Brink Accelerator last year, at the start of last year. Similar sort of thing, for the food tech focus. And obviously there was a side-by-side cohort that was going through on the metaverse side with Brink. So we formed some great relationships on both sides. So there's so many people you can learn from going through that and having that experience. Some accelerators you will receive a cash payment or a cash investment in exchange, obviously, for equity, some form of equity in your business. Some accelerators have no financial component, and others there will be the potential for investment from the providers of the accelerator, or the funder behind the provider of the accelerator. So yeah, I guess that's the description at a high level. Hopefully that helps explain a few things to some of our listeners.
I think that would be really useful for people who are newer to this type of environment, and then especially the science side looking to understand more about the business side of things. And in that vein, can you? I mean, I know this sounds like a broad question, but how does venture capital work? How does it differ? How does investing via venture capital in a startup potentially? How does that differ from buying shares in a company? And what other types of investment are there? I mean, I hear about angels and VCs, and I think you probably can talk about this one for a little while, knowing your ability to explain these things well. Thanks, Paul.
Yeah. Thanks for that. I don't know about that, but I'll give it a go. So obviously, most people are fairly familiar with buying shares in a company on the share market or via the stock exchange. So, for example, for Australians will understand that if you wanted to buy shares in Commonwealth Bank or ANZ or NAB or one of the large big four banks here, most people would be familiar with. You could do that. So you could go and do it either by your online account, or if you had a broker, and purchase shares in that company for a very small amount. For our international listers, it would be the same thing for was Facebook, it's now Meta, Tesla, Google, any of those companies that are listed on the stock exchange. You could go and fairly easily purchase a small amount of shares in those companies. When you've got a small business, though, that's not listed, you don't have that avenue available to you to sell shares in your company on the share market or on the stock exchange. And typically, you'll be raising private investment through a number of various different means. Venture capital works to fund a number of those private companies primarily. And so how a venture capital firm works is there's a couple of different role players within a venture capital firm. So there are general partners and there are limited partners. And so I'll do my best to explain both of those and their role. And there's obviously other roles within the firm, but they're probably the main ones. So the general partners are basically the people managing the pooled money within the venture capital fund that they have raised from investors who are typically high net worth people or corporations, and those people are known. Those investors are known as the limited partners. So the limited partners basically hand over their money to the general partners to invest for them. So the limited partners stay behind the scenes. They're basically passive investors. So the general partners are typically the ones that you will deal with as a founder. So you wouldn't be dealing with a limited partner. They would be completely separate. So as a founder, you're dealing with the general partners, or most typically, junior associates throughout the venture capital firm. So people that potentially screen deals for the general partners, for example. Now, the general partners are responsible for obviously managing, the pooled funds that they obtain from their investors. So it gets a little bit complicated because they obviously, as a venture capital firm and as general partners, have to raise funds from their investors who are their limited partners. So in the same way, we would as a business go and raise funds, the venture capital firms go out and raise funds as well. So the general partners are responsible for the investment decisions, and they invest the money that they've assembled or raised from their limited partners. And obviously they're looking for companies to invest in, companies to support, and venture capital firms range in size. They range in the amount of funds that they have available to invest. And they might have an investment mandate where they will look at only food tech companies, or only software as a service companies, or only climate tech companies, or whatever focus they have, whatever experience they have, whatever industries they're experienced in, and feel confident in making assessments and investment decisions. They'll typically focus on one of those. Now, the general partners will invest that money, and they'll earn a percentage on the funds that they have under management, so like a management fee for managing all those funds, which is typically 2%, and they'll also earn a percentage of any profit they make from their investment. So which is typically 20%, and there's normally some sort of hurdles involved in that as well. So they're responsible for all this money they've raised, and typically will be in the millions. And their job is to, find companies that fit their investment mandate, and invest in those. Well, screen those companies to see if that's a company that they want to invest in, and with the goal of obviously making a profit for themselves and for their limited partners. And that's just a continual cycle that they will go through, that all venture capital firms will go through. They normally have a horizon or a time frame that they're looking for a return in. Typically, sort of can be between 7 and 10 years from my experience, and so they're looking for a return on investment from the money that they've put in within that time frame, and that could come from a couple of different ways. If they invested in the company and that company was acquired by another company, so there would be a buyout. Obviously, you would hope that would be at a higher price point, after from where you bought in at. So there's potential for that. But typically, what you're looking for is for a private company, to go public. So have an initial public offering, to list on the share market, and then open up the potential for a much higher valuation, and for people that are not investing, not considered what is called a sophisticated investor or a high net worth investor, and investing in venture capital funds to get access to it. So your everyday investor, and obviously that is typically at a much higher valuation than what you started the company at 10 years previously, for example. So venture capital is a really interesting industry. Obviously, venture capital firms or investors or general partners are looking at the probability of success of your business. They will go through a due diligence process when they're looking at your business. So if you had a business as a founder, you would pitch to that potential venture capital firm. The people associated there, you would send them basically a pitch deck, most likely that probably roughly 10 slides, which covers off what you do, why you do it, the size of the market, how big could it get, your team, and all those sorts of things. You'll have a conversation with them, and then you'll go through a period of due diligence if they're interested in your business, which could cover a whole lot of different areas, whether that's business or strategy, your technology, and those sorts of things. And due diligence is basically just, the investor or the venture capitalist is looking to understand your business, understand, the business model, whether you've got a product or a service, where does that fit in the marketplace? How big is the marketplace? Like how big could your business grow, which obviously impacts, how much return they can get on their investment. Financials and those sorts of things as well. And that'll go through, that could go for a few hours, or it could go for a few months, that process. It really does just depend. And then they will decide if they want to invest in your business. And then when you get to that point, you're really talking about the terms of the investment. And typically, the valuation is a key component of that. So basically, what price per share they would be investing at. So what do they value? What do you both value, or do you agree to value the business at? Which you would have an idea of, in your head before that point. But yeah, so the valuation, and then obviously, you would be discussing how much they were going to invest, and what percentage equity or ownership they would get in your business. So. And the VCs will go through that process regularly, daily, with multiple companies, looking for companies that they think are a good investment, and they'll build up a portfolio, obviously, because in each company they'll only invest a small amount of the funds that they've raised. They're looking for multiple companies to invest in, which obviously spreads the risk. People often refer to the power law, which I won't go into, but basically, a high-level description of that is, you're looking for, you might invest in 10 companies, you expect 5 of them to break even, 4 of them to go out of business, and 1 to give you a 1,000x return. That's not quite. Don't quote me on that, because those numbers aren't quite right. But as a basic understanding, you're gonna have 1 or 2 outperformers in that portfolio of 10 companies that you invest in, and knowing that some of those other investments aren't gonna do as well, and you just have lower expectations of those. So they're really looking for those outstanding investments, or the businesses they think can be outstanding investments and give you that 10x, 100x, 1000x return. And then obviously they're accountable to their limited partners, and they get their profits, and then the general partners potentially make some profits after that as well on the return from the fund. And so that's one way of raising capital for your business, and that could be done through when you're raising, that could be done through a priced equity round. So that's what you'd be familiar with if you knew of all these companies keep changing their names. I was going to say Google, but it's actually Alphabet, isn't it? On the listing. Who hasn't changed their name? Let's go Tesla. You would go and buy shares at $360 per share. So you knew that you're investing, for each share it would cost you $360. So that at a high level replicates a priced equity round. You know exactly the price that you're purchasing each share for. Another way that is gaining popularity in recent times, and is very popular internationally, is to invest via what's called a safe note. There are other notes available as well, but a safe note is quite popular. Less popular or less well known in Australia. I believe the safe note originated out of Y Combinator in the US. I'm happy to be stand corrected on that, but that's my understanding. And a safe note basically is typically used in the early stages of funding. So a lot of people are probably familiar with these terms, but not really understand what they mean. And they're terms like pre-seed, seed, Series A, Series B, Series C, and so on. So when we're talking about different stages of funding, they're typically the stages that you will go through. So a very early company will raise potentially a pre-seed round, which is obviously before a seed round. There never used to be a pre-seed round. I don't know who names that, but it used to start at seed, and then someone decided that no, now we've got a pre-seed. So they came up with that term, which makes sense. But so a pre-seed round, you might be a very early stage business. So you might just have an idea, and you've got this idea that you think could be a business, but you need some capital to get started. So you might go and raise funds from family, friends, colleagues, people that you used to work with, people that you know, and other potential angel investors. So an angel investor is someone that is not a venture capitalist. So it's not a business. It's an angel investor is an individual person who has some typically savings to invest that they've acquired either from their own business or just from working, or many different ways. And they like to invest that money, typically smaller amounts, in early stages of businesses, because obviously typically the earlier you invest, the lower the valuation is in a business. So if you thought I've got this idea for a business, well that's probably not worth very much at this point, compared to if you had a business up and going, you had a shop that sold shoes, and you sold 300 pairs per week, and you made $10 profit per shoe, and you had an established business that had been running for years. So it's as a basic example. So you would think the valuation of that would be slightly higher. If you had a multinational business, obviously that would be much higher. If the potential market for your business, the valuation would be much higher. So with the lower valuation in the early stages of the business, you could buy in to that business at basically what we would call a lower share price. So you might be able to buy in at $1 a share. If you saw the Tesla PowerPoint presentation that there's this idea for electric cars or electric vehicles, yep, I'm in. It's $1 per share. Now it's 500,000, 1,800, whatever the price is today. So you'd be buying it at a much different valuation. So the objective there is, as an angel investor, if you buy in at an early stage, yes, there's more risk. Obviously, that idea, that might not get off the ground. There might be other reasons why that business doesn't succeed. But because you're taking that early risk, you're buying in at the lower price per share, and you've got a much bigger opportunity for profit and upside of that getting from $1 to $1,000 per share than if you were to buy in at $900 per share. That 1,000 extra return on that, you'd have to be at $900,000 per share, which is much more unrealistic. So there's a risk reward trade-off there. But angel investors, just typically just individuals who are interested in investing in private companies, for that risk reward payoff. And so they would typically invest in the pre-seed round. The seed round, most companies, this varies widely across industries, but the seed round. So at the pre-seed round, you could raise any amount really, but it could be anywhere from $10,000 up to $1 million, sometimes beyond that as well, depending on your industry, and obviously the timing of the macroeconomic environment. And then seed round, you might have established the business, you've got the business up and running, you've got a team of people now, you've made some progress with your product development or the software that you're developing, and you want to raise your next round, and that's your seed round. You would typically raise some more money, so it might be $3 million or something like that, and obviously again at a higher valuation, because now you've established that it's not just an idea. Now you've made this progress, you've reached these milestones, you've shown some progress and development. And that goes on and on and on through Series A, Series B, etc. And they're just progressive rounds. They're just made up terms. You can't nail them down to anything specifically. It's just like going 1, 2, 3, 4, 5. Like they're just made up sequential terms. You could call your round whatever you want. Really, it doesn't really matter. But that's just the terminology that's been adopted, and because it's widely adopted, and everyone uses it, people just sort of follow suit, which makes sense. As you wouldn't come out and just say, I'm raising my Series Z round, because that wouldn't make sense and people wouldn't understand what you're talking about. So that's just a sequential thing. But what I was going to mention was the safe note. So going back to the safe note. So a safe note is not the same as a priced equity round. A safe note stands for simple agreement for future equity, and it basically works like a convertible loan without a debt element. So basically, under a safe note, your investor will agree to make a cash payment to the company, which is not a loan, so there's no interest payable on that. It's just a straight cash payment to the company in exchange for a contractual right to convert that amount into shares when the company closes a priced equity round. Now, the benefits to that really are that it's really difficult to value a company when it's at the early stages. So, like your idea for the shoe shop. Well, what's that worth? Who knows how to value that? Like, nobody knows. Even early stage into your business, like, how do you know what that company is worth? You might have designed a shoe, and it looks amazing, but you haven't made any sales. You've got no distribution. Like, how do you value that company? It's very difficult to impossible, really. And that applies across biotech, particularly, probably more so in biotech than anywhere else. You've done this research. You think this hypothesis that you've worked out, you think it's going to work. You think this is going to provide a solution. Well, how do you value that? Who knows? So typically in early stage companies, the safe note is used. The safe note has a couple of key variables in it. which is typically a valuation cap, and also potentially a discount rate as well. I won't go too heavily into the details, but the valuation cap basically limits the maximum valuation that safe note will convert at. That can be converted in pre-money or post-money terms, which I won't go into the details of that. They are fairly self-explanatory ones. Pre-money is obviously before your external investment comes in. Post-money is after that external investment comes in. It's important to know if you are getting involved in this space and raising via safe notes, but for the point of today's conversation, I won't go into that any deeper. And a discount rate as well. So there's oftentimes anywhere between like no discount rate up to a 20% discount rate. And again, that discount rate is off the future valuation. There are some clauses around that in terms of which applies, whether it's the valuation cap or the discount rate. But as an example, let's say if your pre-money valuation cap that you agreed to with your investor via the safe note was $10 million, then that investor's shares could not convert at a valuation higher than $10 million because you've got that valuation cap. So if you were to raise at your next round, say your seed round, at a pre-money valuation of $20 million, the people coming in at that point in time, which might be 2 years down the track, would come in at a $20 million valuation. So they would obviously get less shares for the amount of money they invested. You, because you hold that safe note and have got that $10 million cap, your shares would convert at $10 million. So obviously there's a huge advantage to that. If you had the discount rate as well, let's just say there was a 10% discount rate, and if we forget the pre-money valuation cap for the moment, but if that valuation was 20 million and you had a 10 million valuation cap, you would obviously come in at an 18 million valuation, ignoring the pre-money valuation cap, just to keep it in simplistic terms. So you've got a valuation cap and sometimes a discount as well. You don't get both of them, you get one or the other at the time, but yeah, that's one of the other instruments that's widely used. Some of the benefits to that, it's a much simpler document. It's a very sort of straightforward contract, just with those variables around obviously the amount you want to invest, any valuation caps or any discount rates, and it's much simpler than going through a price round. It obviously varies depending on what country you're in and the regulations in each country around details that are required, disclosure documents when you're raising a priced equity round. It does really vary across countries. Australia has obviously quite established and strict financial regulations for good reason. So there's plenty of things that you need to be aware of there. But yeah, at a high level, lots of startups in the early stages use a safe note. You can agree to a valuation cap with your potential investors. You don't have to agree on the exact valuation at that point in time. That will come out, in the next round when you do raise typically a priced equity round. And that's pretty much it. It's similar to a convertible note. The convertible note, which people are probably more familiar with, at least in Australia, will often have an interest component. So you would receive, the investor would receive an interest payment at an interest rate. So it's more like a debt element to it. But yeah, so convertible note, safe note, and priced equity round are typically what you would see in the early stages.
Thanks, Paul. That's really informative. A couple of comments, I guess, from me, and correct me if I'm wrong, but I think that's safe notes are the way Magic Valley is receiving investment at the moment. And a slightly cheeky question or comment. From my understanding of what you just said and from what you've explained to me before, safe notes might be safer, but they're not entirely safe because you've got to risk something to get a reward. So this is investment still. So it's not an entirely safe investment.
No, it's good marketing though.
Yeah.
For whoever came up with the acronym, Simple Agreement for Future Equity as being safe. No, you're right on both counts. So we raised our pre-seed round via SafeNote, and we're raising our seed round via SafeNote as well. Yes, so there is risk involved. So obviously, at the time that you are executing a safe note, that's basically giving you the contractual right to convert that amount into shares at a later point in time. So you're not getting the shares at that point in time. Well, I guess one of the risks there is that, you know, if the company doesn't raise a price equity round, it goes out of business, for example. There's absolutely no recourse for you because you're not a shareholder. You've just provided the investment via the safe note. So there is that risk element. So there's obviously risk in investing by any instrument in an early stage business. So there's definitely no guarantees. I think the numbers are pretty well known in terms of business success and failure. Business is it is a risky business. None of this is financial advice. Let me just make that clear. I'm just trying to we are just trying to help educate people on some of the terminology and those sorts of things. And I don't mean any of this is financial advice. Please get your own financial and legal advice when considering any investments. But yes, from my experience, just giving an overview of the terms and the I guess the key benefits and some of the disadvantages, obviously, as well.
I guess with that preamble, it's a good time to ask the question is, so cultivated meat, there's been a lot of investment over the last couple of years and even this year. Could you talk a little bit about what's going on in the cultivated meat industry overall in terms of investment and the projections that are being made about what size this industry might be by 2030, by 2050?
Yep, thanks for that off-the-cuff question. I don't have the numbers in front of me, but I actually saw a slide today at the conference, which was detailing the amount of money that has come in particular into the cultivated meat space, food tech in general, really, alternative proteins, and encompassing all of those businesses. Last year, there was a distinct spike up in investment within the industry, which had been building, over the past 7 or 8 years, and reached a real peak last year. There's obviously been a bit of a dip off that peak this year for a number of reasons. Obviously, there's a lot of macroeconomic concerns and considerations that affects investment. Obviously, worldwide, pretty much, interest rates have been going up. Obviously, investors are looking on a return on investment. If you can get 6%, 8%, 10%, whatever the case may be, in a fairly secure, what is referred to as risk-free in terms of like a government bond or something like that, a fairly riskless investment, then obviously if you were to invest in an early stage business, you'd want a much larger return, which obviously makes it less attractive, and it also somewhat pushes down valuations as well for you as a business owner, because investors are looking for a larger return. They want to invest at a lower valuation for the potential to get a lower share price, for the potential to get a higher return on investment as compared to what they could get from a safer, as referred to as a safer investment, in a publicly listed company, or in a government security or something like that. But look, there's been a huge amount of money that has come into the cellular agriculture space, so cultivated meat, precision fermentation, and that sort of has really enabled a number of companies to make some really strong technological advancements. There's been a number of companies enter the space, so lots of new startups come into the space. But that's not to say that there isn't challenges and risks in the funding environment at the moment. As we touched on earlier around Silicon Valley Bank, a lot of investment is sentiment driven. So there's lots of surveys that come out around investor sentiment or consumer sentiment or business sentiment, because a lot of it is not technical. Not everyone is sitting at home with their models of their probability models and what's going to happen and all that sort of thing. A lot of it's just sentiment. How do you feel?
Yeah.
What do you think's going to happen? How is everyone else reacting? A lot of it is a bit of a contagion effect. Oh, well, so and so said this, so I'm doing this, and it just sort of snowballs. And so obviously there's been a lot of talk around the plant-based meat space, and a lot of I guess the more well-known companies have had a lot of funds poured into them. They've had some declines in the share prices, the ones that are publicly listed on the stock exchange. And there's been an explosion in the number of now plant-based companies that are popped up as well, and creating all sorts of different products, which means more competition, obviously. So there are some funding challenges, across the industry. A lot of capital has been deployed. We saw sort of last year that a lot of those venture capital firms have begun to hold off a little bit on making further investments as they see how things play out. Whether that's to do with interest rates or the food tech industry in particular, or political environment. We've seen wars. We've had the pandemic. We've had all sorts of things. So who knows what's coming next? But so I guess there's a bit of a lull, I guess you would call it. There's probably not as much money being deployed this year into the space as there was last year, and there's not expected to be. It's a much tougher fundraising environment at the moment. If you're trying to raise a round, as I mentioned, there's been quite a number of investors here this week. Some of our existing investors are here. I've spoken to a number of potential new investors. So there's plenty of interest still in the space. I think that due diligence process that I outlined earlier is probably taking longer than it was 12 or 24 months ago, whereas people were probably investors or venture capitalists or angel investors were probably just excited to get into the space and wanted to had a bit of FOMO, wanted to deploy their capital into companies. Probably took a little bit less time doing due diligence because they knew if they didn't get in quickly, then they might miss out. That environment's probably changed substantially since then, and investors are taking longer to do their due diligence. I always mispronounce that word, due diligence. And so, people are, taking longer to make their investment decisions. They're being more cautious with their investment decisions, and it's probably that probably makes sense for that to happen. So, yes, there is plenty of money that is poured into the space. Things have slowed down, a little bit in the last at least 6 months, maybe a little bit longer. So it'll be interesting to see, how that environment changes throughout the rest of the year and into next year. We'll wait and see.
Oh, thanks, Paul. I think our time in the studio is coming towards an end. So I guess I'll end from my perspective by wishing you luck talking to investors and in your search for the best plant-based ice creams on the planet, and hope you enjoy the rest of your time in San Francisco, and look forward to catching up with you again in person next week.
Thanks, Andrew. It'll be good to see you in person back in the studio, and I'll be keeping an eye on the footy scores.
All right. Well, great to talk to you, Paul. Thanks a lot. And for those, thank you, listeners. Thank you for listening to the Magic Valley Hour. I think we're almost at exactly an hour. This podcast. And please look for us on our socials, our website www.magicvalley.com.au, our Instagram at Magic Valley Food Foods, Twitter at Magic Valley Food, and yeah, it is food and not foods because you can only have so many letters. And yeah, and we're on Facebook and TikTok as well. Thanks very much.